All right. So, what was the big surprise in yesterday's report?
Bean yield.
No. What was the big surprise in yesterday's report?
Lower acres.
Lower acres, and a lot lower than expectations. Steve just a little bit ago was talking about FSA yields and such connected with the RMA. Well, in a year like this, with all the volatility that we had in the spring from both price movements between corn and beans and also less than ideal planting conditions throughout a lot of the U.S., it really shouldn't be all that much of a surprise looking back that you could have a lot of volatility in acre changes long term. First off, on the June report, they already told us that they were going to resurvey North Dakota, South Dakota, and Minnesota. We've seen tremendous changes there. Then you get your first FSA data that suggested that from like a prevent plant perspective that maybe we could see bean acres go up 100 to 200,000 acres and lose 200 to 300 in corn. Well, what we ended up having happen was losing 600,000 acres in corn and 1 million acres in beans. Big changes. Now, let's talk about the process again that USDA is using. And I'm here not to represent USDA or to agree with them or to disagree with them, but it's imperative in the environment we're in, you understand what is being shown. And if you want to sit there and say USDA this, USDA that, you better understand what they're doing before you go down that path, because you're completely derailing yourself from accomplishing what you're trying to do on the farm. You're ignoring facts. So first off, the July yields that we received here, the August yields. Last month's August 12th WASDE was indicative of what from a yield standpoint? Farmer survey.
Totally in August.
We don't like the yields USDA is showing. Well, they're just reporting what you told them. Okay? Now, to the defense of the farmer this year, you're submitting those surveys when? The third week of July, fourth week of July. Generally speaking, everywhere, the crop went backwards very fast from the third, fourth week of July to the second week in August. Like reality had already changed. Now, fast forward to September. What are yields now indicative of? Objective yield survey, farmer survey still, enumerators out in the field taking ear counts, and also they decided to bump up the acreage information from the FSA because typically you're not going to get that until October. They made a special announcement last week that they were going to include that in the September report. So it's kind of like a, whoa, flashing red light. Did we have a big change one way or the other that they felt it was that imperative enough and they had the data collected at that point to go ahead and bring that to the market? In turn, instead of having higher acres that I think many were kind of expecting, to be honest with you, I thought we were going to see corn acres down a couple 100,000 and being unchanged. The change was tremendous. But in the September report, it also does not use ear weights, real ear weights. They use an implied ear weight, which this year used a 5-year average. To get to the yields in the state of Iowa, to back into that math, they have let's just say on the record, off the record, whatever, they can't hear that, right? The math that USDA was using basically said that it was very, very hard to get to 200 Iowa corn yield. Very hard. Because the ear weight that it would require with the ear counts that they have to trigger a 200 bushel yield would require last year's ear weight, which was also a record. Is that going to happen in the state of Iowa this year? Are you guys going to have record ear weights on the farm? Might. No certainty though. Might. But you get west of here? Absolutely not. You get south of here? Absolutely not. On beans, you have to have near record pod weight to accomplish the bean yield that Iowa has punched in right now. So there's still production cuts likely yet to come. That hasn't been factored in yet. I promise you, I'm going to piece all this together and come back to all this. We haven't changed harvested acres yet from actual abandonment or chopping. Yesterday's acreage update was strictly planted acres. The acres harvested will drop There's plenty of areas that were chopping more acres than what they intended to because they were obviously getting less tonnage. You have acres that were completely zeroed out. It's happening actively every day in Kansas, parts of Missouri, obviously Oklahoma, Texas, parts of Nebraska, parts of Southeast South Dakota. No, there's zero here. We're zeroing it out because you're not going to get anything through the combine. Then you also had the caveat to that. There's operations that just had to flat out stop chopping corn because the tonnage wasn't going to pay for the chopper bill. So kind of rough to be in that situation. So we haven't adjusted harvested acres yet. We know that the process for what they use for yields is not finished yet because they'll take actual ear weights in the month of October. So the expectation is, hold on, our production is going to drop lower. That's likely, right? The probability of that is greater than 50% in my opinion. However, if you think yield is going to go down, what do you think your carryout should do? You would think that your carryout's got to drop, right?
But they dropped some of the demand in that report yesterday.
We are probably at pipeline supplies on corn and beans now. Got there a lot faster than I ever thought we would. Pipeline supply means we're just flat out not going to see our carryout go lower because you're not going to use what you don't have, right? In 2012, it was impossible for us to get our carryout on beans below 80 million bushel, and it was almost impossible to get it below 800 million bushel in corn. Well, what happened? We keep a certain amount of grain around, theoretically, that we're just not going to take it anything lower than that. And furthermore, we've made a lot of advancements in the industry since 2012, so our pipeline supplies or pipeline supply benchmark is higher. Some would say that's as low as 150 million bushel in beans, probable closer to 200 million bushel. In corn, it's probably 1.1 at its worst. In order to get our carryouts lower than where they are right now, you're going to have a surprise on the end of the month stocks report. So I'm going to make the argument that the cash markets have suggested that that's going to happen. We're running dry. My personal opinion that beans probably are pretty close to what they're using today. On the corn side, I would say that there's a pretty good chance that we're going to see a cut to ending stocks on corn, which September 30th is basically the final recap of the year prior. Does that make sense? September 30th stocks report. That's your next big needle mover prior to the October WASDE. I shouldn't say next big needle mover. We got needle movers happening every day in this market. So to pair all that together, what I mean by your carryout not being able to go lower, your futures market, being back closer to $15 November beans, being back close to $7 December corn, we very well may be nearing a point that it's going to be tough to see those prices move higher and sustain. And the reasoning is you have to have outside money be a participant in those markets to move them around up and down. And our open interest in the market, tracking all positions, whether it's a commercial, a speculator, or a farmer, has plummeted big time, record plummet in the last 6 months. The game is too expensive to play. It's hard for people to take on a position and get paid. They got paid big time on the big run up from this last winter to the beginning of the summer. And they've kind of just been non-existent since. So to think about this, typically an end user, let's just say we're talking about a Cedar Rapids area producer here. Typically the end user is going to do some work to get ownership from the farmer. But oftentimes they're dependent on the board helping them, right? If Chicago Board of Trade goes up 20 cents and basis drops a nickel, well, the farmer still got 15 cents more for their grain, right? And oftentimes you'll see a farmer movement really start picking up when the market moves and it softens basis because they have filled their consumptive demand for that time frame. I really think that there's a possibility that from basically the 50% mark of harvest, it's going to be tougher for the board to do the heavy lifting. It's going to be tougher to entice outside money to come into the marketplace, have a big position, and get paid. So now it's the job of what to get the grain from the farmer. And what has basis been doing? Cedar Rapids was just $1.25 over 2 days ago. Now they're 90 over, I think. It's going to see a slide in the harvest, but as long as you have a carryout that really can't go lower, and your big players left in the market is your consumptive user that has to buy futures to get their demand, and a farmer that has to sell futures to offset their product, that's your exact 1-for-1, right? It's about as easy as it can get. It's crazy to think that at $7 board price corn that is maybe the world that we're going to be in for a period of time. Does anybody know right now what would entice speculative money to come in and start shorting the living heck out of grains? Because they didn't short it when we sold off from $7.50 to $5.50. They just flat out got out of their longs. Nobody has an answer to that. I don't either. There can be something that causes them to come in, and that's kind of what ties back to the margin protection conversation. That's an unknown, but right now it does feel like from a crop that you're getting ready to harvest, the cash market is going to have to do the heavy lifting from here forward. Just theoretically think about if you had $1 million and wanted to go, and you had to go trade something. Are you going to go buy $7 December corn? And how easy is it going to get paid? To get paid means the market has to go higher, right? Who's going to push it higher? The user might, if the farmer's not selling, so on and so on. Don't want to get too deep in the weeds there, but just want to make sure that it's kind of understood that from a marketing standpoint here in the next 90 to 120 days, I don't think you need to be looking at using any type of hedge to arrive or hedges for after the first of the year, for sure, not after March. Because if you recall the spread blowups in the last couple years, that very well may happen again. You know, December, July corn, anybody want to guess what the carry is? There is no carry. It's 6 cents inverted. March to July, inverted. March to May, even money. Dece to March, 3 cents. I can't believe I'm even saying it, that there's a possibility this year that we have December, March corn be even money at first notice day. It's never happened before. Even 2012, we didn't even get close. So spreads are indicating the tightness that we have, right? And it's back to that comment of, we want to talk about big crops or disaster crops. Well, something in between with the demand that we have is just enough. And now it's a long-term market's job to kill the demand or produce more, whichever happens first.
Jared, on that kill the demand, didn't I see that USDA and the WASDE report reduce all 3 classes of use yesterday?
Yeah, and they'll
looking at the supply, we weren't looking at the demand.
Well, did we actually kill demand, or did we just say, well, we can't use it if we don't have it?
Yeah, I mean, but especially the exports, that's 2 months in a row that they've had.
Yeah, but our exports are, you start bringing into conversation the U.S. dollar, rumors floating around that North Africa countries are just flat out of dollars. That makes it kind of impossible to buy U.S. grain because all world grain is traded in U.S. dollars. Just your usage is at risk of continuing to go lower. But the caveat to that is you could find a situation that the last user to the feed trough is the one that doesn't have anything to grind. And they're the ones that ultimately really do kill their demand, right? Your livestock guys, they got to eat, right? Livestock, pigs, cattle, so on and so on. That's going to be a little bit tougher to kill their demand in the short term. But flat out, if your supply continues to reduce from here, don't expect to see monster cuts to your carryout unless we see a pretty, 200 million bushel plus drop in our ending stocks on corn. Does everybody understand that connection? Because I think that's very important, because it's a combination of how you sell your physical grain from January 1 forward. What we're doing right now with most producers is that we're going to focus on getting our sales filled, delivered from harvest through at least January. And from that point forward, I'm strictly a 30-day out seller. Hopefully between now and then, markets give us an opportunity after we harvest the crops says, yeah, I can go ahead and sell that. But I'm not going to play the games of doing just a hedge to arrive or just a basis, because I don't think anybody has the juice probably isn't worth it a squeeze when you're talking about $7 plus corn. And secondly, if you are selling a March futures contract right now in corn, as in hedging it on the board or riding an HTA with the elevator, all you're doing is bear spreading the futures exchange. You're saying, I'm going to deliver now versus July because I think that the relationship of today versus later is going to be cheaper than later. Well, what happens if that goes the other way and you have a delivery problem or the destination is full and can't take your delivery and you haven't set basis yet? What happened this last spring? And then what happened again this summer before we surge back? Anybody remember what basis did locally in, was that middle of April? Right before planting? Anybody know what Cargill Cedar Rapids corn basis did? I don't know the number right off the top of my head, but I'm almost positive that the cash value changed for delivery today by over $1 a bushel in like a week to the downside. Now it came back, but the market got flooded as the board price rose, the farmer started dumping grain, and we bought too much and didn't have anywhere to put it. We bought too much to not use in that time frame. So just keep that in mind on your contracting from here forward. It's probably a time right now just to get back to the simple blocking and tackling. Just thinking about forward cash sales. And if you're gonna play basis games, just be careful. Don't get caught in a situation that all of a sudden you're rolling a hedge to arrive in a 20 to 30 cent inverse with basis imploding at the same time. Does everybody understand what I mean by that? If you have a $7 hedge and you have to roll it at a 30 cent inverse, what's your new price? And what happens if basis dropped 50 cents at that same time too? All of a sudden you're hung out. Everybody remember the HDA debacle years and years ago in the state of Iowa? Same concept. Just be careful. So let's any questions on all that stuff from yesterday and reports coming up our way, so on and so on.
With the higher on-farm storage number, how are they going to lower our carryover? Are they going to say, oops, we screwed up on that?
How do you say that politically correct? Maybe. Last year, what did we see in the September stocks report? Saw, oops.
Yeah,
that was wrong. It's not necessarily an oops, though, because, again, it's looking back in the last 12 months. Where were the numbers right? Where were they wrong? What are we left with? And you have to massage the residual accordingly. I mean, if you want to complain about USDA, it's still the best agency in the entire world from reporting grain. There ain't nobody else that has the same reporting system as we do. So when it comes to the stocks report in September, something to keep in mind that the March stocks report out to the June stocks report suggested that the farmer went from above average selling pace on the March stocks report to a below average selling pace on the June stocks report. What were prices April, May, June? Specifically April, May. Did the farmer shut it off? I doubt it. I hope all of you were selling something in April and May. But if the farmer truly did go from above normal to below normal selling pace, then yeah, the stocks report is fine. Maybe we even see it grow. Cash market would say otherwise. Cash market is begging for grain to come out of the field now because there's just absolutely nothing left in the countryside. And quite frankly, commercial elevators should be empty right now too because they're facing the same inverse that the farmer's looking at on bids. Cash elevators, grain elevators that are not a consumptive user need to have their ownership as low as they can possibly have it in the face of an inverse, and then they'll want to start acquiring ownership once they can start speculating on a carry or actually have a carry presented to them. What is it? Anybody know Cedar Rapids bids here this morning? Just as an example, what the first 10 days of October versus December versus January is?
It was 190 or it was 120 and then 90 and then negative.
Well, that then drops off like a rock. Probably not a fair example to talk about September corn versus gut slot harvest, but there's really just not that much carry out there. So I'm going to shift that over to soybeans a little bit. It's a guess. Everybody's farm is different, but I was talking through some math last night and this morning with a couple individuals on putting beans on a farm. What do you want to bill yourself for keeping beans on a farm for 6 months right now? Regardless of price action, basis, and futures. At a $14 to $15 soybean, historically, what do you think you really have to bill yourself to keep the beans on farm for 6 months? And not quite that, but about 55 to 60 cents in today's environment. And I'm afraid I might be a little low now after interest rates going up again here this morning, basically. Well, they haven't raised rates, obviously, from the Fed, but, short-term money continues to climb. That's a lot of money. When it was probably...
There's another play, I think, in the background, and that's the income tax. There's going to be a lot of people flush with cash. All right, we get into harvest, don't want any more taxable income, so part of that play is going to be, do I go ahead and deliver and accept, payment after the first year on the calendar basis? So there's a lot of things that are going on in the background on that. Go just sell soybeans off the combine.
So I just think you got to keep that in consideration on your marketing strategy on soybeans. I think we're going to probably push a lot of beans to town. We'll look at using basis contracts on the front end of harvest if possible. We'll look at filling our cash contracts during harvest. And then on a tail end of harvest, maybe we'll go back to basis contracts. I don't know exactly what that looks like yet. Kind of depends on the operation. Are they going to be yielding 40 or 50 bushel beans? Or are they going to be yielding 60 to 70? The 60 to 70 guys having opportunities to gross $1,000 an acre in soybeans. You ever done that before? Maybe once. Right? Yeah, kind of writing on a wall. You put them in 6 months ago, and you just got to turn $700 into $1,000, 40% return on your money. Go find me another market to go put that in, and we're leaving the meeting right now. Right? It's a pretty darn good return that you got a great opportunity. Yeah. So I'm just kind of thinking that you just got to be privy of what your opportunity cost is just on that standpoint. If you want to remain a participant in the market, so be it. There's ways to do it. But I'm not so sure that the market is rewarding the farmer at the moment in time to turn over ownership of these beans. And quite frankly, if you do have a big crop come out of South America, if you do, there's a lot of dependency built on that we just flat out won't be the world's first pick after February for sourcing beans for export purposes. Just not going to happen. If they raise a 150 million ton crop, which is 6 billion bushel of beans, how many bushel of beans is the U.S. going to raise this year? It wasn't a few years ago before Brazil was raising 75% of what we raised. They just continue to grow. So I'm just thinking on a cash market perspective, no opinion here on board price of beans going up or down. For a farmer, logistically speaking, I think you are rewarded with getting them out of your possession in the next 60 days, 90 days. And if you want to be a participant in the market, I don't think it's necessarily being a participant on basis that's going to give you your bang for your buck long term. And quite frankly, again, I think there's going to be a lot of cases that why mess with it when you really need a $1, and a half higher price in next year's beans to be penciling in a $50 profit. Right? What are you saying for a break even for beans for next year right now, Chris? We'll have a lot of guys that are $750 to $800 to grow beans. It's a lot of money. What's $800 divided by 60? Well, that'd be 14 and change. Right? No, not quite 14. Right around $14 though.
13.
That's a chunk of change when the bean market right now for next year is not even 14. So I think we need a bean upside move just to help pay for inputs and such for next year. So any questions so far before we kind of talk about some strategies into next year?
So I got a question about hedge derives and corn. Say you've sold a lot of corn for December. Hedge derives. So what would you do right now?
Can you ship it in December? What you have sold? I think I'm sticking with the plan right there. I sold it off of a December hedge derive in the hopes of I wanted it hedged in the first place. I get a look at basis opportunity for that time frame. If the board is not rewarding me a carry in itself, the only other carry that opportunity that can present itself is from basis, right? Cash to cash difference, December to January. And there's few and far between that are bidding more for January than they are December today. Every bushel that has an opportunity to be shipped today at a higher price than later is just betting on to come, right? It's a bird in the hand versus betting on to come. And maybe next summer a guy gets rewarded on that again. It's probably likely. But you're taking the bet that from today until next summer, I'm going to see an appreciation of the grain in my bin from strictly a basis perspective. Does that make sense? You can go manage your futures however you want. Yeah, Chris. $780 average cost on beans. $750 to $800.
Corn's about 1,100 right now.
Yep. So let me wrap your question up with this. If you have hedged arrives and you don't have a plan for them right now, you better have a plan before harvest. You really better have a plan before harvest. And quite frankly, if you're, I'm going to refrain from saying that since this is on. If you have HTAs right now that you can deliver at harvest and basis is good on the front end, I'm using those right away, right? I'm getting rid of them, especially if you know in this part of the world you're not going to be able to store your entire crop, right? You got to ship some grain to town at some point. So if you can execute on higher premiums on a front end and use existing December contract HDAs, one piece on an HDA, if you write it, it doesn't mean that you are locked in for that delivery month. A December HDA in today's world is basically delivery September, October, November, December. When you set your basis, it's setting your delivery time frame. A March HDA is going to be December, January, February, March. Does that make sense?
So if you can't logistically deliver those amount of bushels, would you go ahead and take the little bit of carry that you could to March just for logistic reasons and set the basis at the same time? Or what would you do?
It's going to be case by case, looking at your cash opportunities again. But if you still have a firm January, February, March basis, I really do question if the juice is worth the squeeze to gamble on what the spread does between December, March, May. That what happens if you have a big board run up in the meanwhile and you haven't set your basis, and then all of a sudden March goes skyrocketing past May and your basis plummets. Again, it might be a deal that I have to have this conversation with guys sometimes. When is enough in what you guys do? In any walk of life. When is enough? And when should I just make things more simple than complicating my life when times are very, very good? It's not like the old phrase of in desperate times, take desperate measures. We're not in desperate times, right? I mean, stick to the simple blocking and tackling. Get your delivery time frame set up. If basis is firm, you might not like it as much as you would really like to see it, but you need to get those sales cleared. You need to get the book clear so you can focus on the rest of the crop. Because it happens more often than not that existing sales block the ability to take that next sale. And especially if the timing of shipments and spreads and basis block that thinking.
Thank you.
Any other questions on that subject?
Just a reminder, be careful. If you're going to take a delayed payment, who you're dealing with. You're an unsecured creditor. We just took another elevator down in Northeast Iowa here the last 6 months. So, be careful the mom and pops that you deliver your crops to and say, pay me on January 2nd. The Iowa Indemnity Fund is not.
It's not
It's
$7 corn, I'll tell you that.
It's not enough. It's a good thing it was a mom and pop elevator, because if it was major, there would be enough money to pay it.
How about,
Famous to run your prepaid.
Yep.
Mhm.
I agree.
What about questions on anything? Or Chris, ideas which you'd like to see talked about? And we kind of really hammered home on margin protection. I think that takes some homework here in the next 2 weeks.
I just field some questions if you got anything else you want to hit on, Jared?
So if you're looking at margin protection as a put over everything, but yet you're also still selling 23 corn to offset your inputs,
Mm-hmm.
should you be under 15%, or really should that be dictated by how many inputs you're buying?
Right now, I'm just kind of sticking with, by January 1st, generally speaking, I want to have about $500 an acre of expenses covered. And right now, we're probably closer to 300. That's just on average when I look across the guys I work with. Some have not much sold because they're more of guys that are purchasing inputs in the spring no matter what, primarily based upon their location and their ability to handle the product, versus guys that can take storage now, take delivery now, or are able to lock in those contracts with the elevator, whatever it may be. They have more risk on the table now. Or it's the same goes that if I can't buy my input for next spring yet because my supplier can't give me an offer, if I'm selling grain, what am I doing? I'm speculating the other way, right? Now it's oftentimes a little easier to manage that situation perhaps than buying the input and not selling the grain. It's one man's opinion. But I don't think there's a perfect answer on what a percent sold is for any operation. It's all about measuring those extremes of where you want to be. And again, back to the when is enough enough. What happens if these 23 corn rallies 50 cents or 75 cents in the next 3 months? That conversation is going to shift quickly. Worst case, even from an insurance perspective, enough is enough. And that's the same thing that happened this year when the board went crazy. Anybody that has a crop problem right now, here and now, if December corn is still $6.90 or higher, we're $6.90 this morning, that's $1 above the spring insurance price. They're still guaranteed bushels. Even if they're not going to raise that crop, they're still long bushels between now and the end of October. And you got to translate that to next year. A, do I plan on planting a crop? I'm guessing if you're here in this room, you're planning on planting a crop next year. B, once you get your crop actually planted, you're guaranteed those bushels. As soon as that planter goes across the farm, you're guaranteed. Now you're long those bushels versus the spring insurance price. What's my next offset? And it's just, that's the path that I think agriculture's on right now, that not necessarily riding a cliff, but we're on potentially rocky ground. Is that fair to say? Trying to be pragmatic, cautiously optimistic, and just making sure that whatever levers you want to pull, farm by farm, what risk am I willing to take?